So I'm Josh Garcia. I am a consultant. I'm primarily a lawyer, and I also teach a class at University of Michigan Law School called Blockchain and the Law. And the rest of the folks up here are going to introduce themselves, and we'll get started.
Thank you. Lori Gable, co-founder of Figment Networks, and we're currently a staking as a service provider.
Oleg Golubov, General Counsel, COO, partner at CoinFund.
Jason Stone, founder and research at Battlestar.
Matt Shapiro, I'm a principal at Multicoin Capital. Multicoin is a thesis-driven investment fund specializing in crypto assets.
So it's not often that lawyers get to have some ability to speak on these topics. So I'm going to indulge myself, and you're going to all come with me for a little bit in talking about some of the regulatory issues that one faces in space, because they're paramount, especially to investors who are trying to assess the value of a project and the viability of its success, given the complicated regulatory regime in the US. So I have a question for everyone. Can you all name a federal law that mentions virtual currency, cryptocurrency, or digital assets?
Token taxonomy.
Not a bill, but a law, right? This is the point. That would be the first, right, if that is passed, to actually have some federal law in the books that mentions the technology specifically. So what are we stuck with? How are these things even regulated, right? Well, there's the Constitution at the base level, there's law, which doesn't mention this stuff at all. And then there are regulations that are put forth by regulatory agencies, names of which you're familiar. You know the IRS, right? You know Financial Crimes Enforcement Network, or FinCEN. You know the SEC, you know the CFTC. All of their interpretations of the law that's on the books is how we get regulation of crypto. So we're not even talking about laws when we watch FinCEN go and fine Ripple back in 2015, $700,000 for being an unregistered money services business. We're talking about regulation and how a regulatory agency interpreted that. When the IRS said back in 2014 that you should tax your crypto income as you would tax property, it's regulatory guidance, it's not law. It has the force of law in many respects, but it's important to consider law on the books with virtual currency as property in there. You see the similar thing with CFTC when it asserted jurisdiction over commodities, saying Bitcoin is a commodity in one of its enforcement actions, and then saying also that margin trading and cryptocurrencies is regulated activity by the CFTC. And then most famously, or infamously, you have the SEC going out and bringing all these enforcement actions because because based on its interpretation of the Howey test, a lot of securities were sold last year and the year before, right? So the SEC would have jurisdiction over the sale of securities. Most relevant to, I think, investors in the crypto space is the question of tax, right? This goes to the fundamental, really a philosophical point of what the thing is that we're dealing with. With Bitcoin, there's an implied coin that doesn't really exist anywhere, but we're supposed to treat it as one would property, right? Or rather intangible property. And when it comes to staking, as a service, when it comes to generalized mining, when someone receives this digital asset that exists floating in ether somewhere, we're supposed to treat it as tax. Is that fair? Is that right? What do you think?
So we should get tax out of the way because it's literally the end of fund, and people will fall asleep if we talk about it at the end of the thing. So let's get tax. So let me raise it up a level. Jake, I think, did a great overview of describing in-network incentives. But for all these networks to be successful, in my opinion, you're going to have to see real-world end-user applications. And to do that, you have to consider a whole set of real-world circumstances like tax and regulation. And I think many of these networks, at least initially, have designed, like kind of the model you went kids in high school who design the perfect government, and then it was going to work. But of course, it's just your high school class, it's not the real, it's not going to work. So in the case of tax specifically, there are these networks which were designed for people to stake their tokens. However, if you were a fund, I'm not a fund, I don't know the details of it, but if you had foreign LPs and if for some reason these rewards are considered income, that's a problem because now your foreign LPs have to report their income in the US, which they don't want to do, and now they're not going to stake their tokens. So I have literally had conversations with fund managers who are like, I didn't realize this. If it becomes income, that's a problem for me, so I can't actually stake, which is the whole point of the income, which is the whole point of the design. So I think it's important that there's a whole set of off-chain considerations that are going to make these networks successful or not, and taxes one of the more interesting ones.
So we can unless you have something to add.
Yeah, just to touch on the fund perspective, I mean, the answer there is structuring and legal tech, right? So blockers typically kind of handle that aspect of it for foreign investors, right? But certainly foreign investors need to be careful when they engage in any kind of network participation that they don't end up operating in a trade or business in the U.S., which is certainly a concern, and that would expose them to tax liability in the U.S. and tax filing obligations. So, relevant factors there could be, does this happen to be a network that's like purely operating in the U.S., or are they delegating to a delegator in the U.S.? That we don't yet know how this will be treated, but these could be potential factors.
Yeah, so sometimes the confusion around whether or not this thing should be regulated in certain ways on the investor side, right? So we're from outside the U.S., we don't know the law. Sometimes the regulator looks at something and thinks, I think this should be regulated. And here the industry has a chance to take the steering wheel over the narrative a little bit. So one of the interesting points here is the Token Taxonomy Act is a means to take, it's an example of trying to take control of the steering wheel. And also coming to industry-defined terms such as yield, like what constitutes yield in this respect. It's a topic of debate, but the purpose of the top of the debate is to try to drive that narrative around how this thing should be treated. Because you said in one of your Medium posts, what did you say? Like improper definition may result in improper or poor regulation.
So I think you've heard probably yield being described as what you will earn by staking in a number of these networks. I've heard the term yield, and you see rates that range from like 5 to 90%, actually in the case of LivePeer. And I think it's dangerous to improperly use traditional financial terms. One, because in the case of staking networks that don't have any external usage, it's not really yield, you're just maintaining your interest in the network. So the awards, if you stake, just allow you to maintain your interest, and if you're not staking, you're going to slowly lose your relative interest in the network. But more importantly, leaving aside that, is that when regulators do take a look at it, if you say yield, well, that looks like income. So I think we need to be careful as an industry on how we define and use these terms, and also you don't want to mislead people on why they own these tokens. So I think you should own a token in a staking network because you believe in the long-term growth, and you want to lock up these tokens and contribute to the growth of this network so the token appreciation will go up. Not because you're going to get 8% yield that isn't real.
We'll go back to, I want to return to investment strategies, but before I do that, Jason, you're a big advocate about seeking definition, right? What drives you to kind of like get people to agree on a term before going out and talking publicly about it?
Yeah, it's not easy. I would say that the most important thing, looking back at Jake's presentation, was the idea that in proof of work you have block rewards, and in proof of stake you also have block rewards. It's not, they're differently termed by us, but there's the deliverance of additional tokens, maybe through doing on-chain activities like transcoding or off-chain activities, or on-chain activities, and then often, though, the best definition that people actually understand every day is in proof of stake, the tokens are the mining devices, period. And if you don't go any further, it actually helps, I think, people understand quite often what's really going on, right? It's, if you were a Bitcoin miner, but instead of this current status quo, you just received a new Antminer created from the cloud on your doorstep, ready to plug in, and it's your choice whether to plug that in and make more rewards, or you sell that Antminer before you do anything with it, or some combination thereof. Then you're getting toward what is really happening here, right? Like if Bitcoin and its reward mechanism gave you another mining device that was also saleable as a token, they would be the same, or at least at a high level. So yield makes people understand what's going on. They're being delivered additional tokens of that type, but it doesn't really explain what they're doing or what they have to do to get that yield, right? And often, in many cases, it's almost nothing, right? like the original staking coins, Dash, I mean now Cardano's finally launching Stellar, you own the coins, you get more coins. You might have to take a slight risk at some point in terms of security of like turning on those coins, right? Like you have to turn on a miner, and miners don't have the ability to be hacked for their collateral, which is the tokens that, enable you to mine. But I don't, there are no real answers to this. I wish there were. I think the best thing that we can do is craft language around what is reasonable to regulators such that we get the best regulatory treatment possible.
Well, setting regulators aside, Matt, do you often find yourself referring to kind of yesterday's terminology to describe today's technology?
Yeah, look, I think it depends on who you're talking to, and I think that the best way to describe new technology and innovation is oftentimes to look at analogs and precedents that we've seen and we understand in the past, right? And it is the best way to understand this is maybe saying a yield, because everybody understands what yield is. You either own, Apple stock and you get dividend yield, or you own a bond and you get interest income and interest yield. So I think that the analogies they work to an extent, but they only go so far, right? I think you can get into real trouble in just saying, okay, this is how things were, so they have to be this way now. And so I think you want to call on precedents to better understand things, but I think you really need to start thinking and educating and speaking from first principles, and trying to apply all of what we've learned historically to something that's fundamentally new, and make sure that you get the best of both worlds.
And how does that inform sort of the various different investment strategies that funds might take when they look at the space? This notion that you go to first principles, does that have any impact on their investment strategy, or is it two separate questions?
So I think it definitely does. I mean, when we look at this, we're a crypto native fund manager. I mean, this is to us a brand new space. It doesn't really fit into. It's good from an analogy perspective because it's sort of like venture capital, because it's asymmetric risk return profile, and it's highly disruptive and innovative, but the underlying assets also have liquidity, right? And so that's sort of like a hedge fund. And so is it a hedge fund or is it venture? It's sort of somewhere in between, right? There's no real box that it fits in today because it is so new. So as a fund manager, you really have to say, okay, let's take a step back and say, what are these assets? What is the optimal way to manage them, and how do we sort of manage the difference between venture style thesis formulation and tech and market diligence with embracing liquidity and portfolio management and managing risk overall. So I think you really have to. This presents a lot of new opportunities, a lot of challenges, but a lot of new opportunities. And I think that the ability to have an impact on the network is really, frankly, one of the best ways to generate alpha, sustainable alpha too. And so what you really want to be able to do is understand what the right strategy is. And so I think you're seeing people come in and saying, okay, there's staking rewards, there's yield, and you're seeing arbitragers come in and say, great, I can get my 8%. That's great. I think candidly, if you're staking for the sake of earning 8%, I think you're sort of doing it wrong. You could earn 8 to 10% buying a high yield bond, and on a risk-adjusted basis, you should just do that. So what's interesting to us is how can we use staking and delegating and validating and generalized mining, and really think about it in a bigger lens and say active participation. And how can my active participation in this network help bootstrap it, secure it, solve the chicken egg problem, be a user, supplier. There's a lot of different ways that you can interact with these networks. And I think that's ultimately how we're going to drive value. Driving value is going to be, as Lorian said, from capital appreciation of picking the right network and helping it succeed, rather than sort of, I think, just doing a little bit of staking.
So
yeah, I think we would all agree that the fixed income comparison is the most universal thing for everyone to understand. This not yield, but yield like receiving instrument of some kind. And if you look at it like that, it's all about verbiage again, right? What do people understand? If they understand that fixed income is something where you can correctly project out, the flows or the receipts from that instrument based on a number of ever-changing factors. And even though the fixed part of the fixed income is always changing, that is what's happening here. And I don't know why, but that seems to hold better to me than talking about yield. But it also doesn't describe the same thing as yield. So stuff I think we all need to work on together.
So it sounds like your investment strategy, it sounds investment banking, right? To put it, because you're focusing on project, you're let's grow this thing together, let's provide resources to flourish.
Investment crypto bank.
Investment crypto bank.
Banking, right?
Yeah. So Oleg, is that like similar? Like how do you think other funds are approaching the space with respect to
Sure.
using generalized mining as part of their strategy?
Well, so just speaking to us and our take on this, I agree with very much with what you said, generally, I would add that we see essentially kind of generalizing this into more the active participation realm and going beyond staking. We see this as an opportunity to basically either make our existing investments more productive by taking advantage of on-protocol rewards, right? And also being able to gain entry points into positions that are highly advantageous through things like Merkle mining and work blocks and things of that sort, as well as various arbitrage opportunities, right, that are available particularly at the early stage of networks. We view this as an activity that helps essentially bootstrap networks that need participants, particularly in their early stages, and provide this the level of decentralization and participation that they need. And of course, the size of the rewards that networks offer to bootstrap their participants tends to be higher in their earlier stages, right? Not to say that later stage networks don't offer other opportunities, and having liquidity is also important for a lot of strategies. But we view sort of helping our other investments as a big component of this. And really, what's special about this type of activity and what makes it so accretive is that it works in any kind of market. It sometimes works better in markets like today's.
So you mentioned maybe twice later stage investment opportunities or investment opportunities for later stage.
Active participation.
Yeah, what are those? Because those weren't talked about much on slides or here yet. So what are some examples of some later stage engagements with networks that would yield positive results for investors?
Well, so I think it will be interesting to see. I think staking or validating is literally the least you can do to help grow a network. I mean, it's like voting. Care about politics is literally the least you can do. So I think what you're going to see is validators and people participating in generalized mining moving up to, is it incorrectly used, layer 2 type services. So if you're running an LPT validator, you can find yourself in the video transcoding business pretty soon if you're of interest to do that. So I think there's going to be a whole set, hopefully, if anyone uses these networks for anything, there'll be a whole set of second layer, higher level services of which validators can decide and workers can decide whether they're going to be in that business and earn income from it. Video is one obvious one. Not that difficult to run a transcoder. There's a whole bunch of issues associated with will it be better than a centralized service, TBD. But I think that's where this will migrate over time if people start using these networks.
And some of these carry greater value propositions. Like transcoding, you can imagine people in the developing world using media more, right? And so there's opportunity there. But do you imagine that to be an across the board sort of opportunity, or are some protocols favored to excel? I guess.
So I think the elephant in the room is whether decentralized services, whether it's file storage, whether it's video transcoding, can be some combination of less expensive, better censorship resistance, if you care about that, better UX than highly scaled centralized services. So the benefits of scale, great UX, low cost. So I think the question is whether a whole set of people like ourselves can provide these services in some way that is, again, some combination of cheaper, faster, better, etc. And I think the jury's still out on that.
I think obviously validation services and staking and work tokens. I think a lot of those protocols are going to launch, and that provides a real opportunity for generalized mining and earning a return and helping bootstrap the network. But as you think about like later stage projects, like I think the opportunity for investors to be active in these networks is just far bigger. So like even for something like Zcash, like if we own Zcash, let's start using our Z addresses and sending confidential transactions, because we're actually, it's only as good as bulletproof security. Basically, it's great on the privacy side, but it's only good if people use it, because you're increasing the overall security of the network. Now, in MI or Multicoin, you're going to have an impact on Z addresses on the grand scheme of things. I don't know, maybe not, maybe it's not a big one, but if we can start bootstrapping that network effect, that matters, right? If we hold a bunch of rep tokens in Augur, we can monitor a dispute and outcome and make sure that it acts in the right interest of what the spirit of the market creator actually wanted. It could be something in regards to governance, right? It could be something on Maker. If we own a bunch of Maker, then we can start taking our ETH and making CDPs, right? We can increase the amount of DAI that's out there. We can, bid up the collateral for CDPs that go below the threshold. We can, we can start even just buying DAI, right? And helping support the peg of DAI, maybe closer to $1, right? There's all these different incentives that you have when you own the underlying network or something tangentially related, that you can have an impact, even if it isn't something as what you would deem as generalized mining, where you're earning a specific return. Sometimes that value is indirect.
And I think it speaks to the sensitivity of like how important, like how worried people are about the regulatory issues, right? Like just this notion that you can do something which is in all belief good for a network that worries, like creates this vibration around it that you worry if that's going to call attention from a regulator. That's kind of the atmosphere we're in. People are shook and scared. It's not.
Lorian worries that these things aren't going to be used for anything, which is really the true worry of everyone that isn't a regulator. It's true. No. What is all of this stuff if people aren't going to really use it? Whether or not it happens because of something real or not, once you're there, are people really going to continue to use it? I don't know.
You were going to ask
Hopefully.
something?
I was going to say that we can all agree that the answer to your question is that late stage or basically developed networks do create opportunities for participation, and that's I'm sure everybody can agree on that.
What do you guys think the participation opportunity set is with the latest stage protocol, which is Dash?
I personally haven't looked at Dash.
There are none. There's no additional incentive for people to develop anything on that network that has to do with the act of validating. And I think that being said, I'm happy to validate it all day long. So what do we do with examples like that? I don't know.
But you can't just Lauren said before, you can't just actively participate in something because just for the sake of doing it, right? That can't be your sole strategy. You have to understand, is that network going to have value? And you have to be able to fundamentally understand whether it's a network that's designed to have value, whether it's built the right way, whether it can come to consensus, whether there's a difference between value creation versus value capture, right? You have to analyze and understand all of that in order to even make a fundamental investment decision to decide to then actively participate in that.
Well,
it's a prerequisite.
Which is why Dash is curious, because its design was for there to always be a champion, right? The treasury fund Dash is designed so that there was always that person or that entity. And you're saying,
well, think of it. We're talking about the ways in which to participate. There is nothing past the act of running your node, right? There's no additional participation. You can write up a governance vote, but that doesn't yield anything in any way for you specifically. Like Decred, maybe you can make the argument that you could put up your own thing on a Politia and vote for yourself and get other people to vote for you and make some money, but it's like the oldest stage protocols don't have that additional participation layer built in, so it's like, what does all this stuff mean in that context?
So you're saying running a master node and
is not participation.
Voting is not participation because it doesn't actually yield you anything?
Voting doesn't yield you anything additional, right? Okay. But if you don't vote in the protocol, like the newer things, then maybe you don't get that staking reward. Or if you don't participate, then you're blocked out of something the next thing.
I think if you're running a master node, you're participating in the network. It's just whether or not that's a good or a bad idea. I think it's a separate mutually exclusive
Yes,
decision.
there's not the way that we're talking about participation right now.
Yeah, well, I think basically you guys are talking about investment decisions, and that the investment decision that you're making depends very much on who you are, right? And if you are an investor whose business is to, I don't want to say earn, but obtain some sort of value from this activity, and you are savvy and rigorous and technical and curious, and you're reviewing these networks anyway. You're constantly trying to understand what the opportunities are. You can certainly evaluate them both as an underlying investment and as a as something that can generate on-protocol rewards to sort of sweeten that investment, and view those two components separately, right? As well as your desire to support the space, to support a particular network. But if you're a staking company, you have a whole other set of considerations, which is what does the universe of potential delegators look like on a particular protocol, and then how can you access those potential delegators for sure.
I have a question for Lorian. So I'm gonna reveal your sports shop, if that's okay.
You can do that.
So Lorian has a sports shop in Wyoming, is it?
Yeah.
Yeah, what you call
It's one of those businesses that like people pay with real money for real
Yeah.
goods.
Trading
And walk out like skis and stuff like that.
And so how far removed
Crazy idea, right?
how far removed is this conversation from that world? Like how far away are we from having a retail investor who's gonna walk in your store and get some skis actually think of investment opportunities in generalized
Right.
money?
So pretty far, although I have thought about ways to combine a hobby, owning a sporting goods store, with my day-to-day business. And I think there are some, interesting examples. You could have a local currency, for example. Here's an actual use case for Bitcoin. There's been, there's some towns in Vermont that have local currencies to encourage buying local, and that's seems, just pretty big in scale ones, and that would seem to be an obvious use for a blockchain in a small community that want to create something like that. Awards programs, tokens that are basically just the equivalent of a voucher or an award or loyalty, that could work too. But right now, pretty far.
And you guys sometimes feel like you're just very far from your friends who
So far.
aren't in the industry. I mean, how are you guys working to close that gap, if at all?
I pay my aquarium maintenance guys in crypto of my choosing. But because we're friends. Basically, but that's like a single case. I try and make that happen as often as possible, but it's tough. It's really tough.
I mean, this is we're in the weeds. Like if you're in the audience right now, you're interested in space, right? We have a long way to go. This is going to take time, right? And there's no substitution for education. I mean,
I will say,
even left.
for someone who sounds pretty skeptical up here, you are starting to see some real use cases, I think, finally. So, for example, on Cosmos, there's a VPN use case, which VPN, decentralized network, makes sense. Most VPN providers are actually centralized. If you care about having a VPN, then you're going to care about censorship. So VPN seemed like a real useful application in this model. Rural internet service and having distributed Wi-Fi. So we are actually starting to see some use cases. My question is whether it will be better than a centralized version.
Well, I think a lot of people discount enterprise, and enterprise, as soon as you say the word, it's extremely boring to a lot of people. We're all sort of
That's more
distributed. That's more tax. We're already past that, right? Past the low. So it's already we're fans of distributed systems. But for better or worse, right, centralized or permission use cases create sort of much better user interface, user experience opportunities today, and certainly I would say that space, with the improvement of wallets, of key management solutions, of custody, and potential recourse opportunities that are available in that space that aren't available on the decentralized side, they will actually bootstrap that sort of user base and get people comfortable with using these assets, and I'm very bullish on that.
You know what's interesting? I feel like a couple of years ago, when there was a big push to get those NFC readers into retail shops to take crypto, and now that big company in Germany is the world leader, and it takes 100 different cryptos for the few retail shops that still have one. That was 3 or 4 years too early. If everyone went around to their 5 favorite retail places that weren't huge chains in New York or in whatever city, and really tried to convince those shop owners that they personally would get other people that would pay in crypto there to pay for that $150 NFC thing, you know what? Many more shops in New York would probably start taking crypto again. And we're in a place and time now where even people that don't do crypto a lot sometimes will have a phone app with, 200,000 Satoshi in it. You know what? They can buy some pizzas with that now. It's not 2013 pizza, but it's 2019 pizza.
So Before we
expensive
take
pizza.
questions for a bit, I'm gonna ask a very fluffy question. What projects are you guys excited about? For next year. What are you waiting to just have launch?
From the participation standpoint.
Any stance?
Well, from the participation standpoint, it's interesting. So UCipher is a really interesting one. I would second that.
Can you explain it just for people who don't know?
Sure, it's a proxy re-encryption, which basically allows a new level of permissioning to encrypted communications. Probably would be the most concise and confusing way to say it.
Explain it like they're 5 years old.
So if you're running an encrypted chat application, I think is the way that they like to explain it, and people come in and out of the room, you can't just have one private key encrypt the contents of the room once and have that access to that private key basically govern access as people come in and out. Basically UCipher allows that to happen.
So two for UCipher.
And then another one would be Props. So Props Network is actually very much a consumer-facing network for video-enabled applications that is releasing a sidechain very shortly, an Ethereum sidechain that will need validators who will also act as oracles between the sidechain and the Ethereum.
What do you guys?
I like Enigma a lot. It's a multi-party computation-based platform for people to build on. Multi-party computation is an area of cryptography that enables people to encrypt or not encrypt certain forms of, certain pieces of software. And I think it's also interesting. I'm not excited for it, but the launch of Cardano is going to be really interesting. It's one of the few top 10 chains that said that they were always going to be staking and just finally getting there. And with the EOS launch and how that happened, I think it'll be interesting. There's a lot of hate on Cardano, and if they do succeed, great. But if they don't succeed, I think it'll be a real top 10 crypto that will finally just fail and go away. And if that happens, I think it'll actually pave the way for a lot of other things to die, which should have a long time ago, which will condense our industry in a good way. Not that I'm saying I'm not going to be happy staking Cardano, but I think it's whatever the market decides will happen.
I would say layer 1 smart contract protocols that have been in development that are sort of proof of stake, going to be out in the wild. So whether it's Algorand or Infinity or Solana, I think all those are interesting. And then I think the other group that I find very interesting are work tokens. So projects like the Graph or Scale, where you have a staking component to provide validation services and you get paid in whether it's ETH or a stablecoin or something. There's real product market fit for a lot of those projects, and there's real value capture for a lot of them as well.
I'm going to pick a little small project out in Washington State called Althea, which is a rural internet service, which allows the tokens allow for incentivization between routers, and so anything that provides better internet access, rural, and also disintermediates telecoms. That's cool. So
Yeah.
I like that. Yeah, and they're going to run on one of the staking-based protocols.
Well, we're gonna take some questions from these folks. So start with the back.
Okay, so while you keep talking about generating yield, that's what you're doing because you keep getting more tokens. How do you balance the risk of selling off the assets to maybe earn that actual yield and serialize? Because technically, you're just earning yield with a token that's also very risky and it's already low market cap. It's very even more risky involved. So how do you guys find the balance of saying, all right, this is enough of this yield we earn, or selling some of this off to just still validate, but then also get some fun off?
That's why we need more quants in crypto.
Sure. Well, in general, it's just like any other investment decision. It's multifaceted. You look at the market conditions at the time. You look at the state of the network is in. You look at the other participants on the network and the specific game theoretic considerations involved, and you make that call. I mean, a lot of people, getting back to the really awful beginning about tax, a lot of people need to sell in order to pay the tax because they're taking maybe the conservative but currently accepted position that on-chain rewards are taxable, and essentially, a lot of folks will kind of be caught off guard and not realize that they're sort of taxable at the time of receipt. And so essentially, one of the important ways of managing that is exercising control over when you actually obtain receipt of the asset. Where if there is some sort of an unbonding period, you can actually make the choice of when to unbond and go through the period when, a costly period when you don't earn rewards while your token's still locked up, and kind of just make a decision on, leave the decision in your own hands.
So that's a great question. Another way to ask that question is how much does it cost to run this network? And whatever that number is, in aggregate, is how much it costs to run that network. So whatever the miners of Bitcoin are selling to pay for electricity is the cost that has to come into that network to, in theory, support the token price of Bitcoin. So whatever hundreds of millions of dollars per month that is right now, that's the cost of running that decentralized network. And so that's the result of whatever the answer to that question is. Another way to look at it.
There are more questions in the back. We'll work up over there on the left. That's my left, your right.
Is there a reason that generalized mining has to live in meat space with countries and borders and taxes and regs? Can it live completely autonomously online?
Yes, we hope so.
Have you guys seen anything?
I mean, I will say anything touching finance, there will be some governmental entity looking for a choke point, right? Looking for someone who they can touch, that manages other folks. And the more decentralized these things get, the harder that single person gets defined. But some of these networks actually end up, even if they are decentralized, end up needing a face, right? Like you mentioned, there are people who are really like shepherding a network, or networks at the late stage will be better off if they have people kind of acting as a champion of the network. I say champion, you didn't say champion. But there might, that person might be a potential touch point for a regulator, even if they don't actually run the network. So there's theories of liability that have been tested, notably in the Zachary Coburn order with Ether Delta, that are these weird like secondary liability theories that are troublesome. But ideally, as Oleg said, yes, right. Like, that's the idea.
Is there anyone currently running mining or generalized mining staking services anonymously?
Yes. In fact, so the answer to your question depends on the token holder and their fiduciary or not, I think primarily, or whether they're crypto native or not. But people will, for example, in Tezos, contribute to something called a bond pool, which is actually giving up custody to anonymous teams in weird jurisdictions, usually in Eastern Europe, maybe Russia, maybe not. And they have your tokens, basically. So people are doing it. I think it's kind of crazy. There's been not that many exit scams, which I'm kind of surprised about, only one or two so far in the Tezos. People are doing it, but I don't think any institutional person is going to do that right now.
That's a way to basically kind of stay out of the regulators' kind of reach. Not that they're not subject to the laws of the various jurisdictions they're in, obviously, but it's just taking advantage of anonymity. So that's probably not what you're getting at.
If you finally want to come back to fiat though and buy anything that doesn't accept crypto natively from any retailer in the world, you eventually have to touch the real world again.
There's another question to my right, to your left. Yeah.
So, how many guys run a fund? How much do you guys run a fund? Sorry.
These two.
These two. So when you guys invest, right? I mean, I'm fund finance also, not crypto, right? And you guys look at a network, right? So when you guys deploy capital in like buy mom and pop money, right, or institutional money, how do you guys assess how do you get it out, right? So, at an early stage for a network, right? How do you assess that the network will grow so big, there'll be more newcomers in it that you can take your money out, build liquidity? Like how do you factor liquidity at that stage? How do you influence it?
It's a CK's question asked another way. And it's smart because it's the most risky thing.
Yeah, I mean, it depends. I think Oleg said before. It depends on the strategy of the fund, right? And so, if you're a liquid fund, then you value liquidity. You have to understand risk management, portfolio management, and position sizing. So, You have to really understand what the liquidity is of the individual asset that you own that you're willing to stake. You have to understand the difference between published liquidity versus real liquidity. You have to then sort of discount it further and understand, what is the liquidity of the counterparties that I'm diligent, that I'm willing to take counterparty risk for. So you sort of dwindle down and find an addressable sort of liquidity that you are comfortable with, and then it's about position sizing. Say, okay, on a risk management perspective, how many days, what size am I willing to have on an average daily volume? How many days do I want to be able to get in and out of my position? And that's sort of going to dictate a lot of the parameters around the size that you're willing to do. If it's an early stage network and it's a token, it's a SAFT or it's an early stage investment, it's illiquid by nature. The way that we approach that is it's a much smaller part of our portfolio to compensate for that risk of not having liquidity. And so once those projects launch and there becomes liquidity, then you start to exit or add on to that position based on sort of the fundamentals, product market fit, how it's working or not working.
So as you're a fund manager, how do you kind of, how do you incubate these networks?
Well, I think whether you're a fund manager, whether you're a staking provider and you're taking fees in those coins, or you're providing additional services for them and getting more of the coins as a fund, all of us have to be long the protocols that we're willing to support. People have tried to do this thing where they'll just run validation services or run nodes for people just for the profit, and I can't think of one of those businesses that still exists today. I think the last one's closed in Q1 2019, and it's because during the crypto winter, there wasn't an ability to convert those coins back to Bitcoin and then actually have any operating capital. So it just wasn't a real business, though it should have been, I think. I don't know where the parsing that out comes down to, but
I think in this space, incubation and sort of value add comes in the form, in many forms really, comes in the form of advice on the specifics of the protocol, of strategic decisions, and really all the same type of advice that VCs have always provided to their sort of portfolio companies, right, at the early stages. If you're close to a project team, even in the later stages, you are kind of doing a lot of the same thing. But the reason why we're here today is that sort of generalized mining and network participation is exactly sort of the lifeblood of networks. And that's something that investors are particularly well positioned to provide. And if you are diligencing these things anyway, and you are thinking closely about these protocols, it's a no-brainer.
So we have one last. Your question is going to be the last question. So
good.
okay.
so good.
Like you guys are in this interesting period of this brand new industry, right? Where, especially for those of you who are actively mining, it sounds like all of you kind of are on some level. There's interesting hustles that you can do to have a difference between one and the other. But at the end of the day, it's just bunches of computers and software, right? When this stuff all gets adopted, for an outsider looking in, it just seems like naturally it's just gonna Amazonify into one giant consolidated company that's gonna do all of the generalized mining for all the protocols out there. Why am I wrong?
I can take that. So I think it's a fairly impoverished view of what staking as a service can be. So we got a whole host of off-chain considerations, SLAs, tax, reporting. I've been in with a fund who said, look, I don't care. Don't tell me about your security infrastructure. Tell me about reporting. So I want a CSV spreadsheet that reports what my earnings are. Literally, that was the conversation. I know you can run a data center. I also think there's a whole tooling set that, as an insider to these networks, you can build. So you can look at, hey, what does this network need? Does it need a block explorer? As an overly simplistic example. So we'll go build that block explorer, and maybe there's a business model around that in some way, or some other type of tooling set. But as all of us participate in these networks, you do have a view for what people are doing on it and what they might need. And in our case, we like to try to build some software. Other people might have we're going to be very active in governance. We're going to be the experts, and we're going to get paid for
But that all sounds like early era hustles. I mean, I agree that's all right. That's the next 3 or 4 years.
Right.
That all just gets optimized with a ton of computers that just see how to sort this out over time through layers of abstraction.
We're all service providers though, whether you're a fund taking investor capital or whether you're a client of one of ours. It's all the people who own the coins control the network in whatever distribution that is. So yeah, there might be service providers that are centralized, but they'll only get there if we allow them to, because they're proving to us that they're run in a way such that each individual token holder has full pass-through control of whatever decisions their tokens are entitled to. So I think that we don't get there unless you have one centralized entity where it's literally just a placeholder that enables people, that's like a portal where people go to decide how their tokens are going to be voted or used or whatever that is. And I don't think that that's the same thing as an Amazon, though.
Amazon Web Services, that's what I mean. Like,
Well, no, but they have controls and permissioning, right? If you own the coins, like if I own my VPSs on Amazon, Amazon can't decide what to do with those VPSs, whether or not I'm breaking the rules, right? If I own the coins and I want to break the rules and face the consequences for that, I can do that, whether or not there's a service provider in between me and the blockchain. So it's kind of like a yes, you're right, and no, the world doesn't look like that if we get there, I think. It's more, Amazon for the people, by the people, right? And which would be like a super weird, not Amazon thing.
I think that's a good place to stop. Thanks, Jason. Thank everybody for being up here, and thank you all.